I want to start off with a little bit of a game. And so I'm going to give you a scenario. When I give you that scenario, you're going to end the sentence with me by shouting one word. And it'll make sense as we go through it. All right. So when we make money in this country as business owners or as a W-2 employees, we pay what we call income. And when you sell a property for a profit for more than that you paid for, you pay capital gains. When you work for yourself as a business owner and you build your empire, you pay what we call self-employment. When you want to pass down investments or estates, etc., to your heirs and the people you love, you pay what we call estate. Even when you die, the government hits you with what we call the death. All right. So let me ask you a question. When you review your P&L as a business owner, your profit and loss statement, what do you think is the single biggest or largest expense in your P&L? Almost.
Taxes.
It's taxes. There's
certain things in life.
death and taxes. And death and tax. That's the crazy part. In this country, or at least anyway, IRS will tax your wealth at every stage of the game. At every stage of the game. And it's really important to pay attention to that because that's just money leaking out of your business, money leaking out of your empire, so to speak. And what I've realized and at least learned in a decade of overdoing this is most business owners do not see this leak coming, right? So think of your business or business owners as like, let's say they have a bucket, that's their business. And they pour into that bucket. They pour all the water into the bucket, 80 hours, 90 hours worth of weeks, right? But the leaks keep happening slowly, silently. And guess where that drain goes to? IRS. Down the street here. Right? And unfortunately, most business owners don't see this leak because they usually work with an accountant that's a historian, meaning they just report what happened in your business last year. Like in April, in February, in March, you probably, hey, tax time. Can you file my taxes? It's in the rearview mirror. It happened last year. They're not going to be able to seal this hole for you, right? Because it's in the past. So what you want to do specifically as a business owner is focus on what we call working with a strategist. So like Luis mentioned, I'm a tax strategist because I enjoy working with people throughout the year rather than them coming to me during tax season and be like, hey, file my taxes for me. And then they're going to owe $10,000, $20,000, $30,000. There's not much I can do at that point, right? But during the year, we help them implement tax strategies to seal that hole, to seal that drainage from leaking to the IRS. And because why? IRS did not do the 60, 80 hours with you, right? You're the one pumping all the hours to get that money. So it's really important to start transitioning to working with a tax strategist that will tell you what you need to do to preserve your wealth. All right. So today I want to focus on 3 easy areas or 3 ways you can plug that hole to make sure that you keep in more of your money. By the show of hands, raise your hands if you took a travel in the last 12 months with people that you cared about, friends, family, and you talked about business. You talked about your business strategies. You traveled in the last 12 months and you talked about business strategies, talked about your business goals, and you discussed business. Okay. Keep your hand up if your business paid for that 100%. There's your leak. And let me tell you what I mean. As business owners, you can formalize what we call board of members or board of advisors. And when you do that, these travels that you take personally can now become 100% deductible. I'm talking, it could be your wife, your husband, girlfriend, boyfriend, John Doe down the street. You determine who ends up on that board member. And because of that simple change, now that expense that you're going to pay for anyway becomes tax deductible. Like if you spend $15,000 on a trip, the hotel becomes deductible, the flight becomes deductible, and your meals are what we call 50% deductible. But all you did was change the paperwork. You were going to take the vacation anyway. You were going to take that trip and you were going to talk about business anyway. Now, all you have to do is document it. You create the minutes, you talk about strategy, you formally assign who is on the board. So that's leak number 1 that you can easily plug to save more and make it a pre-tax event. get the deduction on your businesses. All right. The second leak I want to talk about is what we call like family leak or generational wealth. So today, let's say for your kids, you spend $14,000 for their after school activities, swimming, karate, piano lessons or whatever. You as a business owner normally do that. You spend that $14,000 with after tax money, meaning Uncle Sam got their cut and then you pull that money and then you pay for your kids. What if I told you you can instead use pre-tax money to pay for that? So what you do, you hire your kids in your business. You hire your kids in your business. It doesn't matter. Social media management. You could do telemarketing with them. You could have them clean your office. You could have them answer phone calls. As long as they're doing legitimate work, properly documented. You could take that same $14,000 you were going to spend on them and now reroute it as a pre-tax money. And you are the parent, you're the custodian, they're minors, right? And you decide where that goes. So you can use that same money, pay for their karate class, their swimming class, tuition. You could do whatever you were going to do anyway, but you just have to legitimately hire them into your business, get the documentation right, and now you use pre-tax money. Let me tell you even more powerful way for generational wealth with your kids. So you take the same $14,000, now they're earning, right? Since they earn, you can create what's called a Roth IRA account. A Roth IRA account is a tax-free retirement account that you can pull out at retirement. You can fund $7,500 per year for your kids. Let's say you fund the maximum $7,500 starting at age 10 up to 18. You fund it for 8 years, you do not fund anymore. By the time they retire with compound interest, considering 7% return on S&P 500, we're talking $2-3 million your kid will have at retirement. Tax-free. 100% tax-free. Like, where do you do, like, you using pre-tax money and then buying them retirement? Millionaires. Yeah. Yeah. And if you, yes, sir. Yes, sir. So these are like two favorite strategies that we use at our company. First one we talked about is turning your lifestyle. The second one is hiring your kids and opening a Roth IRA account. All right. And yes, 1000% legal, 1000% backed by the IRS code. And the crazy part is when you pay them, they don't even have to pay payroll tax. It's completely legal to not pay payroll tax for them. You don't have to file any payroll tax for them. Go ahead.
So my question is I do have a grandchild doing stuff in the business, but first thing, the age factor. I was getting ready to do a I-9, the whole 9 yards got to do for hiring. So how do you get around that for a doctor?
Yes. If it's a grandchild, the workaround is you take the parent and essentially create a company for the parent. And they become what we call a management company to essentially provide that service. Because this workaround where your kid does not pay payroll tax and it becomes exempt is if they're your child. So what you do is for your child, you hire them, they start a business, but then the money you pay them indirectly goes directly to the kids. Nobody pays payroll tax on it. So that's the workaround we use.
Thank you.
You're welcome. And it's 1000% legal because that's what I get every time. It's like, oh, can we do this? Yes. Legitimate back. My license depends on it. And the third leak I want to talk about is folks around equipment or heavy machinery or even vehicle purchases for your business. So traditionally, let's say you buy a $2 million warehouse for your business, whatever you got to do. Traditionally, the cost, that $2 million acquisition is, the cost of it is spread out on your taxes over the next 39 and a half years. What that means is you get to write off $50,000 every year for the next 39 and a half years, right? That's a drop in the bucket for a $2 million warehouse. What we do is we do what's called accelerated depreciation. So you take that cost of $2 million, instead of looking at it as one box, you divide it up into components like the carpets, the plumbing, any other specific like furniture or tools, etc., within the building, we take those components and accelerate the depreciation. And what that means is up to 30% becomes a write-off in 1 year. So for $2 million, that's nearly $500,000. So instead of writing 50 every year, you get to write off $500,000 in year one alone. So Jimmy, if you made 500K, that means you write off 500, zero in taxes. But if you only wrote off 50, you have $450,000 to pay tax on. So making sure, again, you work with a strategist to accelerate certain depreciation, because that's going to free up so much cash flow for that year. When you write off 500, instead of writing off 50, you have so much cash flow at hand, right? So that's really important. Yeah. So the following, depending on the lifespan of the components, you could still have the same, or it could be less. So what you do is, instead of taking over 39, you brought some of it forward. So that means it could be less going forward. So like the warehouse at the end of the day would still be 39 years, but it would be like maybe $5,000 per year after that. So the idea is to free up cash a year one. You just dropped a $2 million warehouse, right?
Right.
So again, these are loopholes. These are like legit tax strategies that we use with our clients. So I know every business is different. And if you have any questions specific, just grab me on the side. We can do 10, 15 minute. Yeah.
Who's your typical client?
So we focus on definitely small business owners, because some of this information is just not available to them. And like professionals, because they can take advantage of some of the advanced strategies we have. So we have different strategies for high income earners, where we could do like solar credits, etc. And then the small business owners, so things like this.
And you work with people, not just the area.
Oh, nationwide, yeah. So as a CPA, I can serve nationwide. So you could be Planet Mars, as long as it's related to US income tax, I can help you.